All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, welcome to episode 8 of Macro Corner, proudly presented by Blue Line Futures. I am your host, Paul Wankmuller. The topic of today's podcast is the withdrawal of liquidity. The Macro Corner chart book is available in the description of the podcast on BlueLineFutures.com, as well as attached to the email sent to clients. Not a client? Reach out to info@BlueLineFutures.com for a free trial. My guest today is Giannis Mindall. Welcome to the show, Giannis.
Hey, Paul. Thanks so much for having me back on the podcast. We will talk about the withdrawal of liquidity today, which I think is a really interesting topic, given that the Fed has been incrementally hawkish, and looking forward to talk.
Yeah, absolutely. Busy week here in the markets. We have the Federal Reserve meeting on Wednesday of this week, so we will see. We know they're going to raise interest rates, but by how much this time? We've seen a couple surprises in the past, and I believe that it's possible to have 100 basis point move coming here. What are the stats on the percentages today for that?
So 100 basis points would definitely be a surprise, I think. As of the last time that I looked at the probabilities, it was about 75%-ish of a 75 basis point hike. So anything above that would definitely be a surprise to the markets. But it's also about the forward projections that they're going to talk about at the rhetoric during the press conference. I mean, as we've learned sort of over the recent past and years, is that the press conference from Jay Powell will just be as important as the rate increase and the rate announcement itself. So There'll be a lot of rhetoric that people will pay attention to.
Right. And that is if he changes his wording, if he leaves some words out that he might have mentioned at previous meetings. That's what traders are going to be looking for to kind of gauge on where we're headed towards the end of the year, right?
Exactly. I mean, this is sort of a quote that we brought up during our last podcast was Ben Bernanke saying that 90% of Fed policy and monetary policy is talking the rest, the 2% or action. So that just tells you how much importance there is as far as talking and rhetoric goes. So a lot of people definitely pay attention to the press conference just as much as the rate announcement.
Absolutely. All right, well, let's dive right in. Like I said, the topic of today's podcast is the withdrawal of liquidity. Fun little quote here from Aristotle: knowing yourself is the beginning of all wisdom. Can't agree more with that one. So we have here on slide 3, again in the accompanying chart book, that the jobless claims numbers, I see that there's 2 different types. You have initial and continued. What's the difference between the 2?
So initial jobless claims refer to new claimants for unemployment benefits, and the continuing jobless claims are just people who are continuing to receive those unemployment benefits. So sort of one of the dynamics that we've been looking at in the recent past is at what pace will you see tighter monetary policy and also a little bit tighter fiscal policy follow through into the non-farm payrolls data, into the jobless claims data. And we see that there are initial signs of jobless data picking up on the initial claims. So we sort of troughed at above 150,000 jobless claims, and right now that's closer to 250,000.
Yeah.
So we see that number tick up, but we also know that jobs are ultimately a lagging indicator as far as the economic state is concerned. I mean, why is that? Because if you are a business, then you'll sort of try mitigate the economic situation, and the first action is not to lay off for everybody, but that's just a process that happens in the fullness of time. And even as we get to the other side of this, which I'm not saying we are in any stretch, but as you get to the other side of this, then even then businesses will continue to try to run leaner and basically run a tight organization as far as jobs go. I mean, there have been instances where engineers in Silicon Valley got paid as much as $400,000 a year on the entry level, and those and businesses who have to pay that much might not function quite as well on the economic side, and all these things are basically getting unwound as we speak.
I see. Yeah, good stuff. Good stuff. Yeah, I can see there the divergence in these two numbers. It looks like, as we mentioned before, it is a lagging indicator, but it looks like the initials, just from the chart, kind of bottomed out around March, and the continuing claims are kind of in a flat line here. But I do see a shift, and in the current moments, and I believe the jobs are coming out on Thursday. Is that true? The jobs number?
The jobless claims numbers are coming out on Thursday. That is correct.
Cool. All right. Well, that's another data point that we're going to be looking for. Moving on to slide 4 and 5. Now, this one is talking about QT. What is QT, Giannis?
So we talked a lot about QE over the last 2 years, and right now QE has sort of turned into QT. It stands for quantitative tightening,
Okay.
which just means the Federal Reserve is reversing what they did over the course of basically from the onset of the pandemic up until now, which is they bought a lot of treasuries and a lot of mortgage-backed securities from banks and thereby induced liquidity into the system. Right now, they're reversing that process and basically sell these treasuries and mortgage-backed securities that are on the Fed balance sheet, and that ultimately puts increased supply pressures into these markets. So this is just the Fed reversing what they've done on the QE side, and that basically got started on the back of the great financial crisis. That's really when they began QE, and then of course with COVID, you had that $3 trillion step up in QE.
Yeah.
They didn't call it QE initially, but then it sort of turned into this prolonged process of liquidity provision and assuring that the credit markets function properly. And they kept that going for what was arguably too long when you turn to inflationary dynamics right now. But yeah, QT just stands for quantitative tightening, and it's the reversal of the liquidity provision that we've seen. And it's really interesting because it started on June 1st with 30 billion in treasuries rolling off every month, and $15 billion of mortgage-backed securities rolling off every month as of June 1st. And those two numbers are set to double on September 1st.
I see. And that is an important thing to note. The Federal Reserve providing liquidity and making sure that the economy functions and has a place to go. And I'm sure that there's still a lot of 2008 hanging over in maybe some of the members of the Federal Reserve's mind. And COVID kind of came as a shock. Maybe they did a little too much, maybe, but who knew? That was an interesting time in history, I would say.
Yes. I mean, this is sort of the discussion that we have in society and amongst economists as we speak is, okay, there's broad agreement that the initial response as far as assuring that the credit markets would work, assuring that companies could still get access to credit, that was necessary. But then the question turns into, okay, why did they keep it going for as long as they have? And that's sort of the main point of disagreement here. But yeah, as you said, I mean, there were a lot of people who still had that 2008 memory, and that was why we saw an even more aggressive liquidity shock induced by the Fed during the heights of the COVID lockdowns. And yeah.
Right. What is RRP, Giannis? I see this in the top 3 things this week that comes out every Sunday on bluelinefutures.com. Can you explain that for me?
Yeah, so this is basically the reverse repo facility that we're talking about here, which is just a measure for money that the banks can't directly do stuff with. And that's why they put it into the reverse repo facility, because that's where they can ultimately get paid on those excess money that they have in the banks. So what we've seen going on with that number is that's basically gone up to $2.2 trillion, which is a lot of money. And a lot of people talk about that in terms of, okay, there's all this money sloshing around, and that means that the liquidity conditions are still extremely favorable. But that's actually not so, because it really depends where the liquidity gets strained from, in terms of okay, is it deposits that the liquidity gets drained from, or is it the reverse repo facilities that the liquidity comes out of, and that ultimately determines some of the effects as far as risk assets go. But yeah, I mean, that's getting fairly technical. So I would say it's just a measurement of money that the banks don't need right away, and that's why they put it into these facilities that got created
Right.
by the Fed. And yeah, I mean, these facilities stand at record highs right now, and it'll be interesting to follow how it's going to shake out over the course of this quantitative tightening cycle.
Very good. Very good. All right, let's move on to slide 6, the bond market volatility. Volatility is related to the options markets. Not to dive into a little too deep, but from what I understand, this is basically a measure of um, standard deviation, which will be the front month at the money straddle is kind of where I'm going with this one. And this is just a gauge on how far prices are swinging back and forth. Would that be fair to say?
Yes, exactly. I mean, this is looking at implied volatilities of Treasury options. So this is just looking at a blend of Treasury options across the Treasury curve, and depending on how much the market moves, the move index also moves.
Okay.
So if the volatility in the Treasury market goes up, the moves up, and if volatility is really contained, then the move index is naturally lower.
Is it fair to say if this moved index increases, the market is less liquid?
That is one way of looking at it, and that's actually a really interesting point of discussion. So one way I'm looking at the move index right now is, okay, as of Friday's close, we saw it move back into the 120 area and came
Hmm.
off from 156. And that might sort of give the Fed an assurance that liquidity conditions as a result of QT are not that bad just yet. And
Okay.
that gives them room to keep tightening financial conditions. If the
Okay.
move index were to explode to the upside, as you can see on the chart,
Yeah.
back in 2008, where basically credit markets and treasuries were in pandemonium, that would make the Fed a lot more concerned, because if the treasury market doesn't function, that questions the very ability by the treasury to service debt and ultimately have treasury securities represent a safe haven, which it's
Right.
supposed to be.
Sure. Yeah. I mean, and it's, I guess that's psychological as well. I mean, if you don't believe that you can sell your treasuries at any time, or you think there might be, I guess you can call it a credit freeze. I mean, we're theoretically, I mean, that's US credit, right? It's the United States credit.
It's the U.S. government. So
Yeah.
if the credit of the U.S. government is in question, there are extremely large problems at hand. And this is also, as we move further into this tightening cycle, and when we ask ourselves where some of the breaking points are going to be in risk assets, then the treasury market is certainly one of the things to watch in terms of how much stress there is, and that then translates into how aggressive the Fed will be.
Sure. And speaking of risk assets, moving on to slide 7, I see the 5-year high yield CDS, and again, that are bonds that are people want a little more interest than the risk-free rate in order to take on that risk. I do see that it's moved from around 350 near the beginning of the year up to around 550, but it looks like we've come off quite a bit since the highs in June.
Yes, so we've seen highs closer to 600 basis points in the
Hmm.
high yield market, and that's come off to below 500 basis points as of Friday's close. So it's really interesting, because if we think again of, okay, the Fed's tightening financial conditions, that in turn impacts how much money companies can raise, especially on the high yield credit spectrum, where it's naturally harder for these companies to raise credit because the quality of these companies is lower than,
Right.
say, investment grade. And if those conditions tighten, if, say, the credit spread were to blow out on the upside, that just means the Fed's current tightening cycle is turning into a combative action against companies and their ability to raise money on the credit market. So the credit spread is just a measurement of how much return investors in the high yield market demand
Right.
for them to commit capital. And if that spread blows out, that means there's more stress. Companies are less able to raise credit. And that ultimately speaks to the financial stability aspect of things. If that number goes up, then the Fed will certainly pay attention. The fact that it's not at the local highs that we've seen near the 600 basis points might even embolden the Fed in taking more aggressive steps.
Right. Yeah, that makes sense. Again, this is just another barometer of where we are in the economy and how, how the Fed is going to, possibly pivot. We're not really sure about what's going to happen on Wednesday, but looking at something like this and what investors demand out of those risk assets and riskier assets is key to all of this.
Yes. I mean, asking for a pivot on Wednesday is definitely a stretch. I don't think that's going to happen at all, just because inflation is where it is. And even if it cools off, it's still going to be at elevated levels heading into year end and then into next year. But for sure, I mean, financial stability is definitely a consideration in the Fed's equation, and it's not as relevant right now because these spreads are not yet at levels that would be extremely concerning to the FOMC. But as these indicators move north and as financial conditions get tighter and tighter, the Fed will use that opportunity that they have right now to tighten these conditions. Because if they're low right now, why would they wait until in the future to tighten when these spreads are much wider? I'm not saying they will be, because that all depends on how financial conditions get set by the Federal Reserve. But they don't want to wait for these spreads to blow out and get aggressive then. That's when the pivot might happen, if these spreads are at levels where companies are no longer able to take on credit and borrow money from the market.
Right. And speaking of spreads, we have on slide 8, the U.S. yield curve. And this chart shows the difference between the 2-year and the 10-year of the U.S. Treasury market. Let's go into that a little bit. I see that it's actually negative now. And what does that mean with regards to a recession or possibly worse?
Yeah, so the U.S. 2s10s yield curve is the recession indicator out there. So this is the indicator that everybody watches when it comes to the health of the U.S. economy. So what this reflects is the fact that it's at negative 25 basis points-ish right now just means that in the short run, so this is the 2-year Treasury yield minus the 10-year Treasury yield.
Right.
Oh, the other way around. The 10-year Treasury yield minus the 2-year Treasury yield. And what this just means is if that number is negative, the 2-year Treasury yield is above the 10-year Treasury yield. Right. This is reflective of high inflation expectations in the near future, the 2 years, and low economic growth in the out years, which is reflected by a 10-year yield. So as that number is negative, that just reflects market expectations that the U.S. economy will not be in a good shape. And that's ultimately why so many investors pay attention to this. And even as the Fed is trying to talk down the signaling function of the U.S. yield curve, this is extremely critical. And another thing that we need to be extremely aware of is we saw that initial inversion at the end of March, beginning of April, which was basically the Fed hiked, was in the initial stretch of the hiking cycle. It already inverted at that point. And right now it's inverted again. Usually the inversion happens only when they get further into the hiking cycle. So you might have expected that inversion to happen now, as opposed to already seeing it back then in March and April. And so this is just another interesting market expectation pricing that we're seeing right now with the yield curve. And it just tells us investors are concerned about the future state of the U.S. economy. And that's why it's inverted.
Now, what does this mean for banks? If I'm a bank, what does this mean for me and my business going forward?
Yeah, so if you're a bank, you borrow money from the Fed
Right.
on the short end, and you
Yep.
lend it out on the long end. So if this number is negative, that means that it's sort of a losing proposition for a bank that lends money to consumers. And
Right.
this ultimately also impacts how much credit they are willing to provide into the economy, because if you lend in the short run and you basically make a loss on that spread, then it's not nearly as attractive to you. And that impacts, of course, how much credit there is available in the US economy. So that's what it means for banks. And that's also why the Fed, I mean, they do pay attention. They just want to stay focused on combating inflation. And that's why they are providing this sort of rhetoric where they're telling us that they're not paying as much attention to the yield curve, and that the signaling function of the yield curve might not be as we have gotten used to with that recessionary indicator.
Hmm.
But yeah, I mean, this is extremely relevant. There's no way to deny it.
Right. And this is, would you call this a leading indicator or a lagging indicator?
This is a leading indicator. So what we
Nice.
see is that we first get the inversion, and
Yep.
the recession happens thereafter.
Gotcha. Thank you for that. We will be paying attention to that, as well as the jobs, which we mentioned was a lagging indicator. Moving on to slide 9 and slide 10, I see here that we have some currencies. What does this mean with regards to the US? We have the Japanese yen here. We have the Chinese yuan. Let's talk about that.
Yeah, so we have on slide number 9, we have the Korean won, we have the Japanese yen, again, both against the dollar, and then on slide 10, we have the Singapore dollar versus the dollar, and the Chinese yuan against the US dollar.
Hmm.
So what we're basically looking at here is you have cyclically export dependent commodities, currencies, excuse me, currencies like the Korean won and the Japanese yen. I mean, when
Yeah.
you think of these economies, you think in the case of South Korea of companies like Samsung
Hmm.
exporting chips, exporting TVs, all sorts of electronics. In the case of Japan, you think of things like Toyota cars and electronics also, and maybe trains, those sorts of exports that are ultimately dependent on the shape of the global economy. So if these currencies weaken, it just means that there are less flows into the currency than there are out of the currency relative to the US dollar. So the fact that these currencies have weakened to the degree that they have is just a reflection of the fact that the global economy has gotten much weaker, and that the demand for the products that these nations produce is not as high as it used to be. So this is
Okay.
why this is ultimately real interesting and a direct reflection of the global economic activity. So this is the case for Japan. This is the case for South Korea. This is the case for Singapore, which is, of course, well known for being a major export and port hub.
Uh-huh.
In the case of Singapore, that is. And
Yep.
then it will be interesting to see what's going to happen with Chinese yuan. I mean, the currency has weakened, but then also China on the manufacturing side is competing against countries like Korea and Japan. So if they sort of want to keep up with being competitive on the export side, they might ultimately revert to interventionism and possibly some sort of currency uh, intervention that they might deploy if they see that there are competing currencies that are more attractive for overseas demand than their own.
I wanted to add one of South Korea's best exports. I know you're a huge fan, Giannis. BTS and K-pop. Can't forget about that. I know.
Yeah, you just revealed all my music taste. But okay.
Yeah. No, that's great stuff. And I just wanted to close it back out again, talking about the relationship between QT and where liquidity could come out of, under different regimes. And, are there, like we were talking earlier, how the United States Federal Reserve and the Treasury market is one of the largest liquidity providers in the world. Is there anyone else that can provide liquidity like they can, if if anything happened, or how would that work out?
So, of course, there is a certain degree of central bank, call it coordination, because
Uh-huh.
if there is one central bank that's extremely out of whack with everybody else, then that causes distortions. Then the
Right.
counterpoint to that is you have the BOJ basically buying unlimited amounts of 10-year Japanese bonds because they do not want to allow their enormous debt burden to lead to enormous interest outlays by the Japanese government. So, of course, you have liquidity providers such as the BOJ, the BOE, the ECB, and
Right.
also the Fed, but it really matters which of these central banks is sort of leading the charge. And if sort of one central bank is extremely easy and one central bank is extremely tight, and that then that leads to interest rate differentials, which leads to currency fluctuations. So it's really because the US dollar is the reserve currency. It's
Hmm.
the Fed that really sets the precedent for interest rate moves and liquidity conditions globally. But of course, we have talked about policy divergences between the People's Bank of China and the Fed
Right.
in the past. So, of
Yeah.
course, there's not always movement happening in lockstep, but it is the Fed that's basically setting the tone for what is quote unquote allowed in the global current central bank context.
Right. I think you were talking a little bit about the ECB and their rhetoric afterwards from Christine Lagarde, introducing a fragmentation tool,
Yes,
and that
exactly.
that was like you said, they 50 basis point hike, but the rhetoric afterwards changed a little bit, and that's what made markets move.
Yeah, it was that a hawkish 50 basis point hike
Yeah.
to an ECB rate that's now standing at zero. I mean, we hiked rates to zero in the Eurozone. And then you, of course, had that hawkish hike, but on the other hand, that fragmentation tool that they introduced, which basically gives them authority to buy bonds in the eurozone of countries that they deem to be needing of support. So you might have, if they are not satisfied with their interest rate policy transmission,
Right.
say the German bond yields respond much different to what the Italian 10-year bond yields might respond. If
Hmm.
there is a difference that they're not satisfied with, they could step in and therefore suppress that spread between the 10-year Italians and the Bunds. So this is, yeah, we are definitely living in interesting times, and particularly when it comes to the ECB, you of course have a whole lot of different countries, and all these countries have different economic dynamics going on. Each of these countries have different fiscal dynamics going on, but yet you have a central monetary authority that manages interest rates for all of them. So this is extremely tricky for them, and we'll see how it ultimately shakes out. There have been discussions around the euro bond, but we can get into that at some other point.
Yeah, absolutely. I mean, we have a lot to look forward to. Wednesday, Jay Powell and the Fed crew are going to be giving us some great rhetoric afterwards, and we will know how high they're gonna hike. Giannis Mindall, thank you so much for joining me today on the Macro Corner podcast, proudly presented by Blue Line Futures. I appreciate it. Thank you.
Thank you so much.
Absolutely. Don't forget, listeners, the Macro Corner chart book is available in the description of the podcast on BlueLineFutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@BlueLineFutures.com for a free trial. Thank you, everybody.
Informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.